have a lump sum of money that you're wondering what to do with or where to put it so that it's safe, it's liquid, it earns a rate of return, and it would be nice if it was tax-free. You may be thinking, oh, I don't think anything like that exists. Wrong. So I'm Doug Andrew. I've been a financial strategist and a retirement planning specialist now for 5 decades, helping thousands of Americans optimize their assets and minimize taxes. But many times people come to me to reposition assets that they have that are non-performing or underperforming. And what I mean by that is they're earning pathetically low rates of return. It's not safe because it's in a volatile market in mutual funds or whatever. And it's going to be taxed at the end of the day because it's an IRA or 401k and they're not going to be in a lower tax bracket. People begin to realize that they could do better with their money. And so asset optimization is where you reposition assets to increase the liquidity, the ability to access your money when you need it, the safety, okay, the rate of return over where it's at, and convert it to be totally tax-free. If it's tax as earned or just tax deferred, you can do better than that. And so people ask me, well, what is that? And without question, it's a max-funded IUL or Indexed Universal Life Insurance contract. So at the end of this episode, I'm going to talk about my favorite vehicle, which is a properly structured max-funded IUL. If it's structured correctly and funded properly, it is deemed a laser fund, which is the title of these 2 books, which are 2 books in one. And at the end of this episode, I'm going to show you how you can claim a free copy of this 300-page book rather than paying $20 to $70 for it on Amazon. I'll give you one free. So max-funded IUL is like a financial Swiss Army knife. It is the dream solution for all kinds of financial goals. It knocks the socks off of IRAs and 401ks for retirement planning. Okay, it's a great working capital account for business owners and also real estate investors, for lump sums, for tax reduction, for pension maximization. If you're a school teacher, police officer, firefighter, you can maximize what you get in your retirement years, for estate planning, emergency funds, college funding, you name it. Okay, but in this particular episode, we're talking about lump sum capital transfer. That's capital is money. And so many times people get a lump sum of capital from some source. It could be an inheritance, or it could be a settlement for early retirement, okay? A lump sum settlement instead of taking a monthly income the rest of your life until you die. Or it could be from the sale of a business. It could be from a life insurance policy where somebody dies and you get a lump sum of money and it's tax-free. And people say, where should I put this money? And I go, well, I would recommend you keep it tax-free. How do I do that? By putting it right back into an insurance policy. But you take the least amount of insurance this time and you put in this lump sum and it will be tax-free and it will probably double every 7 to 10 years tax-free. But if you happen to die, it will blossom just like the last one did that you are the beneficiary of. And they go, I didn't even know I could do that. Well, a lot of people, you don't know what you don't know because you can't be aware of something you're not aware of. So many times when people will come and meet with me, I'll go around this Swiss Army knife and people will say, oh yeah, I have a lump sum. I have $250,000 that I just inherited or I got from a death benefit or I got from a settlement from this car accident or they offered me a lump sum when I retire. And I go, well, let's make room for that in your IUL. Do you need all of that money right off the bat? No, the majority of the time, no. So what is it earmarked for? Well, for my future down the road. So then I create an IUL policy that will accommodate this in addition to any other goals and money that they want to reposition to increase liquidity, safety, and the rate of return of the tax benefits. Well, what happens, we make room for, this $250,000 or $100,000 or whatever it is. So, it's very simple math. If you have a lump sum, you can calculate how fast your money will double by using the rule of 72. And so you take whatever interest rate that you're earning and you divide that into the number 72 and it'll tell you how many years it will take to double your money. The problem is a lot of people with lump sums have that money in a bank or credit union and it's earning a pathetic 1, 2, or 3%. 3 into 72, it's gonna take 24 years, okay, to double. Why would you want to do that? Especially when the current of inflation is coming down at 7, 8, 9, and you're only rolling upstream at the rate of 3 miles an hour. You're going backwards. And so I like to, first of all, show them the worst rate of return ever achieved with IUL, which is the worst decade since the Great Depression, the year 2000 to 2010. Most Americans who had their money in the market, if they had $1 million accumulated by the year 2000, that million dropped down to 600,000 twice in that decade. And by 2010, it was still only worth 630,000. It took until 2012 before it finally came back up to $1 million. People who had IUL, their million had doubled and tripled in that same time period, tax-free. Now, let's go to the worst case. If you used IUL and you didn't come in for annual reviews and visit us and rebalanced, because those people who came in for annual reviews and we rebalanced, they actually earned an average of 11.17 and they netted 10.07, okay? 10% in 10 years, okay? Your money will double in 7.2 years. But if you only earn 7.2, the people who didn't come in for annual reviews, they earned 7.23. So let's use that worst case. 7.23, let's round it down to 7.2, divided into 72. Your money will double how fast? Every 10 years. If they had a lump sum of 125,000, earning 7.2, the worst that IUL has ever achieved in a decade, 125 doubles to 250. 250 then doubles to 500 in the next 10 years, and 500 doubles to $1 million. Yeah, that's pretty much a no-brainer, okay? We've had many people that they accumulate $1 million, and if they're earning 7.2, which a lot of people think, oh yeah, my IRAs are 401ks, they've been averaging that, until I actually showed them they're only really earning about 3.5%, but let's assume they're earning 7.2. Well, and that means they could pull out $72,000 a year, okay, in annual income out of an IRA or 401k, hopefully without depleting the principal. Well, they have to pay tax on IRAs or 401ks. And in a 33% bracket, because most people are in that tax bracket because they killed their tax deductions along the way, paying off their house, the kids are gone, or if they move back in as adults, you can't deduct them anymore. They're not contributing money to IRAs or 401ks, so you don't have those deductions. If you were a business owner and you sold your business, you don't have those deductions anymore. So people are actually in as higher tax brackets when they retire than they were ever in during their earning years if they save very much of a respectable retirement nest egg. So you pull out 72, you pay $24,000 between federal and state tax. 41 out of 50 states has a state income tax. You're netting $48,000 to buy gas, groceries, prescriptions, golf green fees. That's only $4,000 a month. Now, to me, that's pretty pathetic. I don't accumulate $1 million to have a measly $4,000 a month. But that's the financial services standard. In fact, they only want you to pull out 4%, which would only net you 3% in a 25% bracket. Now, IUL, in the worst decade, rate of return, 7.2%, you pull out 72,000 out of that million, and you will net 72, tax-free. How much more is 72 than 48? It's 50% more money. Would you like 50% more income? Okay, that's why I recommend lump sums go into IUL. But if you want to see your actual realistic rate of return, ever since 1980, people have averaged 9.62%. I have. Ever since 1997, I've averaged 11.17. Let's just use 9.6. 9.6 divided into 72, your money doubles every 7.5 years. I've had many clients who started out with 500,000, even clear back in 1980. That 500,000 doubled in 7.5 years to $1 million. Now they could have pulled out, at 9.6%, 96,000 a year of tax-free income. But they didn't need the money. They let it double. And in the 15th year, it was worth $2 million. In the 22nd and a half years, worth $4 million. And in the 30th year, is worth $8 million. Yeah. We have many clients who have $8 million in their IULs, okay? And that $8 million does what? At a 10% payout, which is a no-brainer in IUL, without depleting principal, you could generate $800,000 a year of income. Now, we have a couple in California that has $8 million in their IUL. They funded it with after-tax dollars out of their IRAs or 401ks. Those IRAs or 401ks were worth $6 million. They bit the bullet and paid tax of $2 million and repositioned the $4 million over 5 years into IUL. And in 7.5 years, that $4 million doubled to $8 million. They now have $800,000 a year of growth. They don't need that much. It's tax-free. They only need $300,000 a year to live on, and they get to spend $300,000 because it's all tax-free. So they're way ahead of inflation. But let's say you were pulling out $800,000 a year out of a taxed investment that's now taxable, an IRA or 401k or the like. $800,000, you're going to pay $320,000 in tax. You will be in a 40% tax bracket. You will only net $480,000 to buy gas, groceries, prescription, and golf green fees. Now, some people say, well, that 480 is enough. Well, because of inflation, maybe that 480 will only buy what 240,000 bought 5 years earlier because inflation's been going crazy. The point is this: why would you settle for 480 when you could have 67% more, 800? Would you rather have 800,000 or 480? You choose. This one will last longer. And that's why I recommend for lump sums, you put it into a property structured max funded IUL. So if you want to see examples of this, I have an entire chapter illustrating this on the right brain side of the book. So go to laserfund.com or click on the link below, contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost, but I do require a little bit of skin in the game, but I'll pay for the book. If you buy it on Amazon for $20 or up to $70, thank you, but I'll gift it to you free. I'll fire it a hard copy to you via priority mail, okay? Now, while you're in there claiming your free copy at laserfund.com, if you like to listen and learn or watch and learn, there's video and audio formats. But you can even register for a free educational webinar that we teach on a regular basis. There's no charge or obligation there. But you can even schedule an appointment there to talk to a certified IUL professional that I have certified so that you can see how a laser fund may be set up correctly, because over 99% of IUL agents in America don't know how to do that. And so you don't want to make that mistake. And so you can see how it can be done correctly. There's no cost or obligation to do that. But I would strongly recommend that you set up an appointment to talk to an IUL specialist that is certified. And so this is not about me. This is about you and your brighter future. And you'll understand why anytime you have a lump sum, doggone it, increase the liquidity, safety, rate of return, and the tax benefits by putting it into a property structured max funded IUL, especially if you don't need all of that money right off the bat. You want it to grow tax-free in a safe environment.